Hey, European DJ. How are you, buddy?
I'm doing fine, Derek. I love this question. I'm doing fine. I'm good. Had a long week at work. You know that. I think our listeners must be getting tired from us saying like we're having tired from work. Let's say. So how are you doing? How was your week?
Good, good. I'm looking forward to next week. Next week we are meeting in the Netherlands. I cannot wait.
Yes.
I
Yes.
have a trip to Italy with work first, so I fly Monday, back home Thursday night. I'm literally in my house for 2 hours, and then I have to drive to the airport and fly to the Netherlands. So it's gonna be quite busy, but looking.
Good. Yeah, it will be nice. We have like 15 people coming,
Yeah.
so we'll have booked a place. So it'll be nice having some food, some drinks, and then in the evening we'll take it into the night and we'll see where we end up. But I think we need to look after each other a little bit there. So
Yeah, yeah.
let's have a nice party.
Anyway, enough about us. Today
Yeah.
we have a guest that I'm quite excited about, and it is Ryne Williams from YouTube and has his own blog. So, Ryne, welcome to Dividend Talk.
Thank you, fellas. I know I told you guys before we started recording, but I've been investing now. This is my 5th year, and from the very, very beginning, right as I was getting into this, the Dividend Talk has been with me the entire way, is what I'm trying to say. I've been listening to you guys ever since the start of my investing journey. So being able to chat with you guys is a really cool full circle moment for me. And I just want to thank you for having me on. This is really exciting for me. I can't tell you guys how exciting it is because it's really cool. So thank you.
Awesome. That sounds awesome. And honestly, we are delighted to have you on the show. I can't wait to actually get chatting to you and hearing more about your journey. But before that, I'm pretty sure most of our listeners will know who you are from YouTube. But just in case, just give a quick intro about who you are.
Yeah. Well, kind of like you guys, I'm an investing enthusiast. I don't have, prior to getting into this stuff, I had no experience, no background whatsoever in finance, and just kind of caught the bug one day and started doing it. And in doing so, caught the bug so much that I decided I wanted to start making videos about it. So I started a YouTube channel. This would have been back in like October of 2020. And it's just been one of those things where I started doing it and I haven't stopped. And for some reason or another, it's kind of taken on a life of its own, and people seem to be interested in my gibberish. And so now I just get to do that as a job, and I'm so fortunate. But like I said, at the end of the day, I'm just an investing enthusiast, like you guys, like a lot of you guys listening, and that's pretty much it. Just a regular dude who likes dividend investing.
Awesome. We have a request from one of our listeners. It was more of a question, David. He said this is the third podcast that he's heard. Well, will be the third podcast that he will hear you as a guest. He's saying you are not allowed to say "not too shabby," otherwise you owe them something, or he'll play a drinking game listening to the show. So every time you say it, David will have to take a drink. So
that's kind of a running joke. That's everyone's got their own phrases, they're the classic catchphrases, and you just come by them naturally. Not too shabby is one of mine, and it's kind of a running joke on my channel. I do a live stream every Friday night called the Dividend Happy Hour, and that's part of the drinking rules of the game. Every time I say not too shabby, you have to take a drink. Every time my cat comes into the frame and he makes an appearance, you have to take a drink. So with that said, like I said earlier, I'm super excited about doing this episode with you guys, and I think when it's all said and done, it's going to come out not too shabby.
It's your first drink, David. Get it in.
There you go.
Awesome. So we usually start with some news of the week. And I believe you had something about Johnson & Johnson.
Yeah. You guys, maybe if you're familiar with this piece of news, you can help fill in the gaps because I've only mildly skimmed it. But J&J made an acquisition announced earlier this week for a company that's just a biotech company that has a particular drug that I think is used for primarily for schizophrenia, to treat schizophrenia. But from my understanding, and I could have this wrong, but I think that there's also potential application for people with depression, which from what I've read is a much bigger market than schizophrenia. So J&J acquired this company is acquiring this company, part cash, part debt, for, I believe, $14 billion. And I think they're hoping that one drug in particular, I don't remember the name of it off the top of my head, but I think they're hoping that could be a really good grower for them, a good growth project. And I think they're projecting, like, at peak, that drug could pull in about $5 billion in revenue per year.
Yeah, it's a very interesting space, schizophrenia. I believe Bristol Myers had this as a phase 2 success the other day. So, and it's really hard to tackle this one. And what I understood is also here that it's not just schizophrenia. I think they have around 2.4 million adults in the US, but also bipolar disorder. So it's really also in the mental health space, as to your point, but even potentially Alzheimer. So, you know, if this really lives up to its promise, yeah, this could be a blockbuster. The good thing is a AAA rating really helps, with these kinds of things.
Yeah, you guys both own Johnson & Johnson, don't you?
Yeah.
I don't.
You don't? Okay.
Yeah, I'm okay with the talc powder case and such. And we were always so optimistic about the lawyers in the States, but they haven't properly dealt with it yet. Still not today. So it's very curious. I think anytime soon they will need to get a new court order about whether they can really file for bankruptcy. There.
Yeah, I think there's still the Texas two-step is still on the table for them. From my understanding, and hopefully this year we get at least some clarity on that. I think that's been one of the big anchors on the share price lately. And a lot of people have soured on J&J because of its lackluster performance. But I think once you see some more clarity in that talc litigation, I'd be surprised if a lot of that downward pressure on the price wasn't alleviated.
Exactly.
I think so. Yeah. I've learned to stay away from litigation, so that's why I got out of Johnson & Johnson.
Yeah, I had to learn that lesson the hard way with 3M. I mean, J&J is a bit different. I think that they've got a much better balance sheet than 3M had, so I feel a lot better about it. But yeah, I definitely came out on the wrong side of 3M with that one.
In Europe, we've got a worse case. We've got Bayer, and they bought a company called Monsanto. I don't know if you've heard of them, but yeah. They took a beating, so we learned that the hard way with Bayer. So
yeah, we always felt like their lawyers should take an internship at Johnson & Johnson, but well, Johnson & Johnson isn't much further either nowadays. So
yeah, no, it'll be interesting to see what happens, but I think they'll make it out okay.
Yeah, I think so. And then the second piece of news I have here is in relation to the FDA. They're reducing nicotine, I believe, in some of their cigarettes. It's becoming like Europe over in America. It's just starting to regulate everything.
Yeah, it's starting to seem that way. And I'd be curious to get your guys' thoughts on this too, but I think it's so strange to specifically target tobacco, because you could take this same way of thinking and apply it to things like marijuana. You could apply it to things like alcohol for sure. Why not cap Guinness at like a 4.5% ABV, or I don't know what Guinness is, but you know what I'm saying? Why not take that same approach with those?
Meta, just Facebook, Instagram,
exactly.
TikTok.
Why not cap the usage limits per day on those? It's very symmetrical. And it's interesting too. Let me know what you guys think about this. But my thought is that people who are, and the whole premise around it is to try and help curb people's addictions on tobacco products. But I don't know. I can't help but think that people will just end up smoking more to compensate for the lower nicotine per cigarette. What do you guys think?
So what I've noticed with definitely around my circle and work and friends is they are reducing their nicotine intake in terms of cigarettes, but they've moved to vaping, which I don't know is any way healthier than smoking a cigarette. So they've just replaced one voice with another voice, in my opinion. And I feel like it go down the same route here. They might reduce the nicotine, but they might smoke more to get the same intake.
I think it will make people feel that they're more healthier than, and indeed have no limits anymore, right? They may even start getting these thoughts that it may be reducing the risk on cancer or something like that. I mean, yeah, but maybe it is true that tobacco companies are actually technology inhalation companies, inhalation tech companies, because that's how they sometimes position themselves. But Ryne, to your point, I think it won't help a lot. I mean, what has probably most helped in Europe is the ban on smoking in pubs and such, in trains. That's what they did like 10, 15 years ago. I think that has been overall beneficial to society in the sense of like you don't smell like smoke anymore when you come home after going to work, all these kinds of things. But I think the smoking itself, then I really don't know where you draw the line. There are many things that are not good for people. We know, of course, that tobacco is not good. Alcohol, I think it's with this, all of this stuff. So for me, it comes down to like my philosophy: everything is a sin stock. Yeah. So why tobacco? Why oil and gas? Really, like the Shell and the Exxon Mobils. I mean, think about, they don't exist anymore. Then how would you meet your family with Christmas? Yeah, okay. They bring nice memories. Yeah, you could give everything a positive spin. Yeah. So with tobacco, it's maybe a little bit harder, but maybe it unites people standing outside of the building, going for a quick smoke, socialize. I mean, I really.
For a lot of people, it's like a ritualistic
thing.
It's a nice break in the day, and at this point, those people they're aware of the health risks, but to them, it's worth it. And to your point as well, you could make the same argument for something like a McDonald's.
Yeah. Exactly. And do you have on the cigarette packages also those half-dead bodies in the US?
What's that?
In Europe, on a package of cigarettes, they show you, let's say, a lung of a patient with cancer. So they show you literally the pictures, how it looks like.
No, I don't think that there's that on the cigarette packets here. I think there's just like an FDA warning that they can cause cancer and other, inverse or adverse health effects. But I don't think they get that graphic with it.
Yeah, that's what you get here. Yeah.
They really want to drive the point home.
Yeah, definitely.
Yeah. But I wonder then, from a tobacco company point of view, will it reduce their cost? If they have to put less nicotine into a cigarette, will their cost reduce? Would they make more margin, more profit off a single cigarette, a single unit? It might benefit them. Who knows?
Perhaps, because where does the nicotine part come from? Does it come from the tobacco leaf? So would they just put less tobacco leaf in there?
Possibly.
So then the inventory of that they have could be stretched across more products.
Yeah.
So potentially.
Might benefit investors and people. Might be a win-win situation.
Imagine if there would be almost no nicotine in there anymore. That would be a reason for everyone to start smoking again.
Yeah, potentially. Like there's so many different reactions to this that may not be taken into consideration.
Yeah.
Another conspiracy I was thinking of earlier when I read this news was, what if there's some closed door conversations happening with the FDA and the tobacco lobbyists, to where they know that they're going to get people smoking more. And so maybe the tobacco lobbyists are in cahoots with the FDA.
Yeah,
you just never know.
Yeah, exactly.
Yeah. Everything is possible and everything's on the table. Who knows?
Yeah, absolutely.
Okay. Enough about smoking and all those voices. I'm crazy to hear about your investing journey. So take us back. You said you started 5 years ago. What made you get involved at that point?
So I got really serious about investing about 5 years ago. It was either late 2019, maybe like November, December 2019, or it was the start of 2020, right before everything hit the fan. I don't remember exactly when it was, but I'm 31 years old right now. So I was about 25, 26 years old when I first really got the bug. And what made me even think to start taking investing seriously was I had heard that classic, I don't even know where, but I'd heard that classic Warren Buffett quote that said something to the extent of, if you don't find a way to make money in your sleep, you're going to work until you die. I'm sure you guys have heard that one. And at the time I was working a job that I really was miserable at. And I thought, when I read that quote, I thought, there's no way I'm doing this till I die. I need to find some way to create some money that can help get me out of the situation. And I heard that quote and I thought investing could be good. Like I knew that it was going to take a matter of decades before that could really, quote unquote, save me from this job. But I thought, the more that I could, if I can start taking steps towards that, at least the light at the end of the tunnel would gradually get brighter. And so that gave me a bit of hope. So, I turned to investing initially as a way to just get out of this situation, whether it was this one or another job. Either way, I knew I don't want to work until I'm dead. Like I'm someone who really wants to, I want to have as much control over my life and the decisions I make and the time that I have, the limited time that I have. I want to make the most of that I can and have as much control over that as I can. And so I think a lot of those thoughts, especially given my situation at the time, really pushed me into starting to do this. And, upon getting into it and learning about it, like I said, I had no idea how to do this stuff at all. I have no background in finance, and I didn't go to school for this stuff whatsoever. And so to learn about it, that's when I turned to YouTube. Because these days, where else do you learn things? Everything that I've wanted to learn in my life, whether it's guitar or learning how to work out or edit videos or whatever, I've always turned to YouTube. And so that was my resource in learning about this stuff. And similarly, also these days, I think podcasts fall in that category too. If you want to learn about something, you also can look towards podcasts. Anything that you're interested in, there's a podcast for it. And that's also how I found out about the Dividend Talk podcast. And so the combination of those things really put me on the path to investing. And the more that I listened to the dividend investors, and getting into it at the time, it would have been like people like PPC Ian, Dividend Data, my man Russ Knopf over at Dapper Dividends. There's a handful of channels that were talking about dividend investing, and just the things that they were talking about, and you guys as well. The more that I learned about this dividend investing stuff in particular, the more that it really resonated with me. There was just a lot about this style of investing over others, like trading options or day trading or whatever. There was more about this that resonated with me than anything else. And so I really, after a handful of months of just kind of floundering with investing and not really having a sense of direction, I finally landed on dividend investing and have never looked back. So, and it's been, it's one of those things where it just gets better the longer you do it. So it really has been the gift that keeps on giving.
And is that why then you started the YouTube channel, to help you learn and to grow it more as you go on, and then pass that on to other people?
Yeah, absolutely. So, and I'm glad you asked that. I mean, my background really is in like social media and photography and videography. I've always had a camera in my hand ever since I was younger. And so I would watch these videos and, I could understand how they were putting this stuff together. And these guys weren't doing anything super crazy. They were just talking about their portfolios and what they're buying and what they're thinking. And I thought, I could probably do that. And to your point, Derek, it also, if you're going to talk about this stuff, it forces you to learn about it because you want to know what you're talking about. And so, yeah, I thought it would be a good vehicle for me to learn more about investing. And that was the one of the big reasons I started the channel, just number one, because it seemed like fun. It seemed like these guys were having a lot of fun just talking about their portfolios. And I thought it'd be a fun project for me as well. And I thought that I would learn a lot just by doing this. And also at that point, it wasn't lost on me that, YouTube can really become something meaningful if you work hard at it. And so just going back to just this job that I hated, I thought this could be another thing that could potentially get me out of this situation. And so, yeah, it was all of those things. But first and foremost, I just thought it'd be fun, like above anything else. And I still, to this day, that's the most important thing for me. I just want to have fun with what I'm doing. And number two, it was a good way to learn more about this investing stuff.
Yeah.
So,
and what was your biggest learning then along this journey? Well,
that's a great question. I don't know that there's been one particular thing, but I can tell you that investing over these last few years, specifically investing in individual companies and just also generally having experience in the market and seeing its ebbs and flows, it's taught me a lot about just human behavior and psychology and how much that plays a role, at least in the short term, and in which direction share prices move and how people think about companies at any given time. So I'd say it's been a big eye opener there, but I've also learned a lot about accounting and economics and finance and stuff that I had no clue about prior to getting into this stuff. And I still have a lot to learn about it. but just by being an enthusiast and an amateur practitioner, I picked up on some things, and that's been really helpful.
So clearly you're also a self-learner, right? And I'm just curious, what was the first stock that you bought? But then also, like, how did it feel to for the first time actually really invest and put real money behind it?
I think I don't remember what the first stock that I bought was, because I think I bought a handful of them like at once. And like I said earlier, I was totally floundering. I had no sense of direction with what I was doing. I was pretty much just following what I saw people doing on YouTube, which is not the way to go at all. But I was just modeling what those people were doing. And so I was buying stocks, like some of the earliest ones I remember buying were, and please don't kick me off after this, but like Beyond Meat, Dropbox, Virgin Galactic, there was a company called, I don't know if it's pronounced Coty. That's how I've always pronounced it, but the ticker symbol COTY. It's in the beauty industry. Yeah. And it was a free stock that you get on Robinhood. When you would sign up, you'd get a free stock. And that was one of them. And I think I ended up buying a few more shares in addition to the free ones. But generally speaking, those are the types of companies that I was buying. And then as I learned more about dividend investing, like I said, I slowly started to lean more into that. And that's when I got into some of the 3Ms, the Starbucks, Coca-Colas, Procter & Gamble, a lot of which I still have today, some of which I do not. But then I started leaning more into those. And in hindsight, I guess this is another important lesson that I wish I would have known at the start. In hindsight, if I could go back, I would have just started with something like SCHD and the S&P 500, just those ETFs, keep it simple. And I'm a big advocate of that these days. I think you have to walk before you can run. And I really threw myself into the fire at the start, and it worked out fine. But I think that there was, in hindsight, a better way to do it.
Yeah, but it was so hard because in that time in 2020, I mean, if you threw something at the wall, it would stick. Yeah, and we had Chamat on CNBC every day talking about all the specs and Virgin Galactic and the share price were just like all going to the moon, right? In the aftermath, because I think the crash was really in March 2020, and after that, like the only way was up. And you had Cathie Wood, so all the stocks that you are mentioning were all in this thing. And even for us, it was so hard to have this joy of missing out. It was so hard because you feel like an idiot at that time on social media. It was like, dude, what are you doing? This is the biggest bull ever, And they learned their lesson mostly in 2021, right? After this big crash and all these stocks, look at where they are today. But it was really, really hard to stay the course at that time. The psychology was really hard.
Don't you think, though, there's always instances of that? Like, no matter what time period you look at, there's always the hot stocks. There's always those hyped up companies that people are just piling into that seem like winners today. But that just goes back to the human behavior and psychology element to it. People see their neighbors and their friends making money on a certain stock, so they pile into, which pushes the share price even higher up, which creates an even bigger fear of missing out for the non-participants who eventually get involved. And then at a certain point, it just becomes this thing that's no longer sustainable, and there's no way that it can go from there. But in the meantime, it's hard to watch and sit on the sidelines when you see other people doing better than you are.
I do think that's kind of always the case. You could say now about Nvidia and such, right? But I think in that particular moment, it was extreme. It was really extreme because no matter what you invested in, all these shit stocks, they went up really, really fast, really quickly. And you were looking at like, dude, this person, like this kid of 21 years old, has never seen something and is doubling the money in 4 months. Then you really start thinking like, hallelujah, right? So, but we stayed the course, and it has done me really well. But that was a tough time, Ryne. And if you started at that time, it's really easy to be influenced with that.
Yeah. No, it's the stock market's crazy, and I think getting into it at that point in time, and since then we've had some ups and downs. Nothing as severe as 2020, but still we've seen our dips in our big big gains as
Yeah.
well. And I feel like I've gotten a little taste of both sides.
Mhm.
And yeah, it's been a good learning experience.
Yeah.
And to your point, kind of like you said, I think that all of that just speaks to the importance of having a defined approach, with this.
Mhm.
And I think if you don't have that, it becomes pretty easy to fall victim to a lot of the hype and stocks that are just being pushed up by momentum. And it can be tough in the short term, but in the long term, I think you're better off just sticking to your guns and sticking to, what you know you should be doing.
But for me, what helps me is the math. I just know that if I buy stocks at, let's say, 3% yield that grow the dividends by 6% each year on average, I will be reaching that goal where my income replaces the expenses. That makes it so easy to always fall back on simple math because I'm quite analytical from that point of view. So it makes it really easy to not get distracted. Well, not really easy, but it makes it so much easier to not get distracted. Just the simple math. Not
only that, but when you set those, type of numbers for yourself, you don't have to reach for gains. You don't have to put yourself in risky positions that could work out, but are probably likely not to. So it allows you to kind of cruise into financial freedom. It takes a bit longer, but you have to do what's going to help you sleep at night.
Exactly.
Patience. I think patience is key. I've tried option trading before. I've spoke about it on the podcast, and it went well for, I would say, 9-10 months, and then I still have 2 companies in my portfolio that have -96 and -97% from what I ended up buying that stock. I keep them there. I'm not selling them as a reminder to just keep it simple, stay in my circle of competence, and get away from that option and trading and stuff. But it was
hopefully they're not. I'm guessing they're not big, big positions in your portfolio, or weren't, right?
No, not huge positions, not huge, but they were still substantial in their own right. But I mean, 97%. When you see that number on your spreadsheet, it doesn't look good. It doesn't look good at all.
But I think, guys, like, we're talking about a lot of things like patience and discipline and focus. And I think that these are important lessons to learn that the market can teach you that also have application in so many other areas of your life. And so, personally speaking, learning about this stuff through this just across the rest of my life has been beneficial. So I think it's just been a huge blessing, and it's been a huge learning experience being able to get involved to this depth. And I'm so fortunate, and I'm so surprised too. Like, doing this and being interested in this has been one of the greatest surprises of my life. If you would have told me 5 years ago that I'd be, number one, interested in stocks, in finance and investing, number two, talking about it for a living, and number three, someday a guest on the Dividend Talk podcast, I would have thought you were crazy. I never would have expected this.
I mean, you did well to start at 26, because at 26, I was not thinking about my financial future, I have to say.
No, but patience. I'm much more patient for my wife nowadays. And I try to have her not compound too much either.
My gosh.
You can really apply it everywhere, the compounding and such. Like, no, don't eat this extra sandwich. It will compound into you. So watch out.
Those sandwiches can be yield traps sometimes.
Oh, yeah, definitely.
I was not expecting that. I was not expecting the conversation to take this turn, I have to say. But tell me then about your portfolio. Let's get off sandwiches and compounding, because EGI is getting giddy. How has that changed then? What do your top 5 positions look like, and how do you shape them?
Yeah, let me pull up my portfolio here, just so
I can tell you. I can tell you.
You know it?
Yeah, SCHD is the top one, then Starbucks, then Visa, then WSM. I think that's water management. Is that WSM?
It's Williams-Sonoma.
Ah, this one, yes, exactly, because that one was your biggest performer in 2024, and then VOO.
You are spot on. Yeah, so those are my top 5. Across I have 2 different accounts. I have a regular taxable brokerage account, and then I have a Roth IRA, which is a particular type of retirement account here in the States. My brokerage account, which I started first, is all individual companies. I think at this point I've got maybe 19 of them in there. And they, they're kind of all across the board. I've got some dividend growth stocks with, lower starting yields, but very juicy dividend growth rates, like the Visas, Williams Sonoma, Lowe's. I would say that those actually make up even SEHD. But that's in the other account. I would say that those make up the bulk of the weighting of the account. I've got some high yielders in there as well, like the Altria Groups, Realty Income, Main Street Capital Corporation. I have some of those, and I have, some stalwarts, some sleep well at night dividend kings like J&J, Procter and Gamble. And so in that account, I've tried to set it up to be like an all-weather type of portfolio, just very well balanced, kind of get the best of all worlds. Adequate share price appreciation, nice current dividend income. I think my yield in that account's upper mid 3%. And then, still some respectable dividend growth in the mid 8% range. And so I really think with that account, I'm getting the best of all worlds, and that's how I'm trying to keep it. And then the Roth IRA is super simple. It's just SCHD and VOO, which is the Vanguard S&P 500 ETF. So I'm kind of balancing those two out. One of them's all, just me trying my hand at investing in companies, and the other one's kind of more just for the safety net, broad diversification of ETFs. So.
And as a YouTuber, right, you're looking into many stocks. So how do you stick to 19 positions?
And I want to get your guys' thoughts on this too, because this is something I've been thinking about quite a bit lately. But I've kind of found that the longer I've been into this, I mean, you just naturally come to understand. You get a good sense of the companies that you're going to be interested in and the ones you are not. There's a lot of dividend paying companies out there, but not a lot of them are, to me at least, great investments that I'd like to put money into. And so I think just with time, coming across these different companies and maybe just spending some time thinking about them, it's easy to decide, yeah, I could see myself owning that someday, maybe potentially, or like definitely not. Like, for example, I don't ever plan to own VF Corporation. It's a dividend payer. I don't feel like I ever need to own that one. Simon Property Group, yeah, it's, nice dividend payer. I just don't feel like I ever have much of an interest in owning that. And so I kind of just run up and down my watch list of stocks and I guess my investable universe, and just kind of think about it from that perspective. What's a maybe, what's a no, what's a more than maybe potentially, and I kind of start narrowing it down from there. And the ones that I'm slightly interested in, I'll put on a watch list that I call my somewhat interested list. And they're not ones I'm super serious about yet, but they're ones that I understand. I've done a quick scan of the financials. I've seen that they're growing companies with, nice growing free cash flow, not a whole lot of debt. So, they've got some of the makeup of what I'm looking for in an investment, but I don't know if I'm all too serious about investing in them. One example of a company like that is Nike. I think it's a good business. It's one of the world's most recognizable brands. Historically, it's been a solid grower. Balance sheet's looking pretty good. Nice free cash flow generation, even very strong returns on invested capital. But I don't know. I just don't know if I have much of an interest in owning Nike, even right now when it's come down so much in price. And I've got a list of probably 25 plus of those, similar types of companies where I kind of have a similar thought process. And then I have one that's a list of stocks that I'm a bit more serious about, and that's much more narrow. There's only 3 of them on there right now. One of them is Rollins, ticker symbol ROL, which is like one of the world's largest pest control companies. Another one on there right now is Old Dominion Freight Line, ODFL. And then the third one is Zoetis, which is a veterinary pharmaceutical company. So those are the ones I'm pretty serious about, and could see myself buying at some point, but I just don't know if I feel like adding any new positions to the portfolio right now. But I guess closing the book on this rant, to answer your question, how do you not, have all the companies under the sun? The longer you do it, you just realize there's not many that are really all that interesting out there. Do you guys feel the same way?
No.
No?
I don't. And I'll tell you why. Because I suppose all the books we read and most YouTube channels, it's all geared towards American companies, and quite familiar with a lot of America. It's easy to get financials, and all that information is staring you in the face. So I probably would be the same in terms of American stocks. European companies are not covered as much. and there's lots of hidden gems that are out there. And we have a newsletter that we do, and we try and do deep dives. We do American companies as well, but we try and do European companies because that's our niche. And there's so many companies that I would never have come across, like Hornback, DHL, which I knew but would have never known them as a dividend payer. European DJI did one on Fuchs, for example. So I find it really hard when I look into these European companies. They're closer to home. I have a bit more of a feeling about them because they're European rather than American, and I just want to buy them. So I had a portfolio of about 45 stocks maybe 5 years ago. I trimmed it down to 32, but I find it's creeping. It just keeps creeping back up. I just see too many good companies that I want to own. So yeah, I struggle. I do struggle to stick. I mean, it's really interesting to hear you have conviction in your portfolio. That's it, and you stick within that. But I don't know, European DJ, if you feel the same.
I have exactly the same as Derek. Although I think there's a much of overlap to what Ryne says. When I go through my watch list, I always come back at the same 4 or 5 stocks that I've been buying already for the last few years that are still kind of in the same valuation, like the insurance company, European insurers. I mean, to get ASR, the 6% yield, it's crazy when you think about it. So I keep shifting back to them. But what I have more, Ryne, is that I turn it around a little bit. And first of all, we don't have this luxury of SCHD here. Yes. So I can't anchor, let's say, 40 or 50% of my portfolio around an ETF and sleep well. So how I think is in a reversed way, like, okay, I don't want to have, I can consume 4 to 5% dividend cuts in my portfolio, knowing that the rest will lift it up. Yeah. So from that point of view, I don't want to have positions that are more than 4 or 5% of my entire portfolio. Because if one goes bankrupt for whatever, and we all know, like, we have always a few winners and a few losers. So I want to limit the downside risk because I take my retirement and then coverage expenses really serious. So if I would focus on 20 companies, and they will probably not be equally balanced because some they just grow into it and others, but also I don't have the conviction for all 20 the same. I would not sleep well at night because surely there would be a dividend payer like 10-15% of my dividend income. Yeah. So that's why I'm naturally already in more stocks as a result, around 40. And then, with the podcast and the newsletter, you see 2 family businesses, not the strongest growers, but you just know for the next 10-15 years, there's a really low probability that they will cut the dividend, because if they would do it, their family would have no income. Yes. And the business is solid enough. So, but I call this typically entry positions. I would buy for, let's say, 500-600 euro or something like that, maybe 1,000 euro. And that's it. Yeah. And then I learn about the company, but it means I need to do every year a spring cleaning or something like that. Throw those out again that I feel like, okay, like to your point, I don't want them. I don't even want to spend time on it. I tried it. I learned about them. No. So that's more how it works. But when it comes to really, like what's there to buy, I shift always back to the same 4 or 5 in my mind.
Mm-hmm. Yeah. To your point too, you guys are a lot farther along on the journey than I am. And so to your point about diversification and wanting to, I guess, be a bit more protective of that income stream, I totally understand that. And I think as I get older and my wealth grows larger, because my portfolio is not even at $100,000 yet. It's getting close, but it's not there. It's still small potatoes. And with that said, I think it's natural to when that grows larger, the larger that it gets, it makes more sense to be more diversified, because especially as you get closer and closer to using that income to pay your bills, because you're using it to pay your bills and fund your livelihood. You need to be more protective over it. So the best way to do that is just to have more holdings. So I totally get that. And I think as I kind of get closer to where you guys are at, I probably will expand this number of holdings as well, for the same reason.
Which is interesting, because investing theory and thinking about risk management, diversification, you really don't need more than 10 to 12 stocks. Yeah, from a performance point of view, that's what the stock, and that was what the investment advisors will tell you. Yeah. Which is interesting, yeah. So, and actually, you may perform even better. I mean, you have Visa, for instance, very large. You will probably outperform with this concentration.
Well, but And this is a really interesting conversation that I really go back and forth on in my mind. I think when it comes to performance, there's more than one way to measure that success. I think we're talking just in total returns, which includes share price. But if you're just thinking about paying your bills,
Exactly.
I think that's a totally different conversation. And I think you get to a point, probably you feel this way, I don't know, but probably as you get closer to retirement, you're less concerned about beating the S&P or a certain index.
Not at all. Not at all.
You don't think so? No, that's not been your experience?
I'm entirely not interested in beating an index. That's what I'm trying to say. I'm only interested in beating my goal, or at least sticking to my goal of dividend growth. Yeah.
Well, there you go. Yeah. And so it just becomes about that income stream and can I pay my bills? And from that perspective, it's like, okay, well, I don't really care about if this is the most optimal, number of holdings for best performance. It's like, this is what's helping me make sure that I don't have to go back to work.
Yeah, exactly. Yeah, it's interesting. I do think like less stocks. I do think not just from total return, but if you invest in the Visas of this world and it covers you, I still think like you have a very high dividend safety. The moment you go to 40, 50 stocks, you're sacrificing on dividend safety as well, because it's really hard to find more than 10, 15 stocks with the best dividend safety in the world and provide an attractive starting yields and growth. That you can count them often on one hand. So once you go to the 40 or 50, lower quality starts sneaking in. That's my experience.
Okay.
So which from one side actually may put your income stream also a little bit more at risk. But me thinking like, well, I will make mistakes anyway. So then at least don't make those mistakes having so much impact on my portfolio. And that's why I think about, from that point of view, protecting my income stream.
Yeah, that makes total sense. I get that.
It's sometimes it just goes back and forth to my mind. Which one is best? Keep my portfolio trimmer, or like I looked at 44 stocks. I thought I had 39. I'm now 44. Yeah.
And then we have Alan, our friend. He must have left 300 stocks now or something like that. And he took all emotions out. He just has an algorithm saying like, okay, ABC, and if it's more than 6% and has grown the dividend for 10 years and another major, I just buy it. So he buys just everything like what he finds in the world. And with this, he has a very high yield in his portfolio, easily covering, he already covers his expenses in quite a few years, and he can have dividend cuts there. It will hardly hurt him because, I mean, and he has tax optimized as well. I mean, it's like another level again, Ryne. But this also shows like the way to how to approach your strategy in dividend growth investing. I mean, there are so many options we can choose here, right? It's actually quite amazing. So it's definitely not boring if people think that.
No, not boring whatsoever. And it's a spectrum. When it comes to dividend yield and growth, it's a spectrum from low to high in both departments. And that's why, that's why I'm trying to just strike a solid balance between everything.
Yeah. I think you have a nice balance though. I mean, we are jealous. We spoke off air, but SCHD is massive. And you asked us, would we change our portfolios and have that as maybe a cornerstone if we had the opportunity? And we both said yes. So I think that's maybe the advantage that you have over us is, yes, we have 40 stocks, but you also got that diversification through a growing ETF that we don't have access to. So
let me ask you guys this, hypothetically, let's say that you were able to get access to SCHD tomorrow, and you'll put some money in it, you'll make it a whatever percentage of your portfolio. Would you then, or maybe you would do this to fund the ETF allocation, would you sell out of some positions in the individual positions in your portfolio? Which, because you guys both have a decent amount of holdings, which few would be the first to go if you were to cut some of those out?
So I have some investment trusts. So it's kind of like ETFs, but they're actively managed. They're like closed-end funds in the UK. I would replace all of those and go straight into that. So into passively managed SCHD, I don't have to worry about it straight away. No questions asked. So that would be about 25% of my portfolio straight off.
Okay, wow.
For me, it would be mostly some Americans like Viatris. It's anyway already on the buy list, nevertheless, but I would sell them like Like, well, the stock market is closed, but Monday morning when it opens, and some that I just have a bit of lower conviction in, like Medtronic. Yeah, I will probably sell. So I have a few of those. I will probably look at that group. Yeah, I would definitely do that. Yeah, Viatris, Medtronic, maybe PepsiCo, because
Really?
PepsiCo yield for yield is pretty much the same. So, and both Derek and I don't have so much conviction in PepsiCo. So yeah, definitely.
Yeah, I get you. I mean, in terms of yield, it is pretty comparable to SCHD right now, and you're getting, I think, about a 5% higher growth rate, dividend growth rate from SCHD over Pepsi.
Yeah, exactly. And PepsiCo with the shrinkflation and the inflation of price hikes.
I saw one of you guys post about that on, I think it was Twitter.
Yeah,
recently.
that was
Yeah.
It's insane. I mean, if I go to the shop here and I see the household brand, I mean, there's just no justification anymore to take it. Only when you have a birthday and you wanna show off that you're buying brands. But I mean, there are people that say the taste is superior. I don't see it. Salty chips are still salty, so you know. So maybe that's one thing, and I don't see many people buying Pepsi. Yeah, it's mostly Coca-Cola. Pepsi is usually at the restaurants, the fast food chains where they have a deal with Pepsi, where it's getting consumed. So for me, I like the business. I like it a lot, like the snack business and the sodas. I just think they have overplayed their hand a little bit. So therefore I assume lower growth. And then SCHD, if you look at what the top 10 there is, I think that top 10 will do on average probably better going forward than Pepsi today. And then if you compare the yields, which are comparable, I wouldn't see a reason why to have Pepsi in my portfolio when you can get that. And probably Pepsi will be a top holding after the rebalancing of SCHD.
Yeah, that's true.
Yeah.
So maybe a couple more questions before we go on to our listeners' questions. And you said you use YouTube a lot, but is there any other tools or books or anything else that helps you along your way?
Oh yeah, I'm a pretty avid reader. I don't know if you guys can see. I got my whole bookshelf behind me there. Most of those are investing books and whatever. But that's been a huge. That's been for me a great way to learn more about this stuff. So I'm a big advocate of that. Seeking Alpha has also been a really good resource for me. You know, I used to rely on them a lot more for things like financials and, you know, share price performance and dividend stats. Now I have my own tool for that, but I still love Seeking Alpha for all of the articles and news. That's and listening to the quarterly earnings calls and reading the SEC filings. It's been really good for that. So I'd still say that's one of my favorite tools. And I'm trying to think if there's really anything else beyond that. I mean, not really. It's pretty much just, you know, if I think about my investing process and just kind of my day-to-day in this stuff, it's pretty much Seeking Alpha's. I'll go on Seeking Alpha every day to read. I'll read books every single day as well. And for me, those have been probably the two biggest tools for me. And then you've got your portfolio trackers, you know, and there's a few different portfolio trackers that I like to use. I made my own spreadsheet, but I also use others like GetQuinn and Snowball Analytics. And I think those have been pretty helpful as well. But yeah, I can't speak highly enough about Seeking Alpha. It's a really good all-in-one platform for sure.
Yeah. I like the comments. The comments are a lot more insightful sometimes than the articles, but yeah, no, I agree.
But do you screen still for dividend stocks, or do you know already so much of the universe that you have it in your watch list, or is it still somewhere screener for you?
I will still screen from time to time. I actually did one last week just based on a few metrics like I don't even remember what I did. Probably free cash flow growth and certain yield and growth rates and stuff like that. And that's, you know, that's always a good way to find companies that you may not have heard of before. And then once I find one that I've never come across or that seems kind of interesting, I'll add it to the watch list. And I kind of just keep tabs at this point on my watch list. Like I was saying earlier, I've got the somewhat interested list and my very interested list. And I'm pretty focused in on those and try and keep tabs on those. And I'll hear about things that happen with other companies as well, but I'm not as concerned about them if I don't have much of an interest in buying them. I also have a watch list with hundreds of dividend stocks. If it pays a dividend, it's on that watch list, but I don't pay much attention to a lot of the companies on there unless I know I'm kind of serious about them.
Yeah. And you mentioned books. What book are you reading at the moment?
Oh, so at the moment, I don't have it here with me, but I'm reading a book right now called The Creature of Jekyll Island, which is about the history of central banking here in the United States. Real riveting stuff, I know. But prior to this, I read a really, really good book on investing. I'd recommend it for you guys too. It's called What I Learned About Investing from Darwin by Pulak Prasad. One of the best investing books I think I've ever read. The gist of it is basically the author's making comparisons between investing and evolutionary biology. And, every chapter is a different lesson from biology that he then ties into investing. And it's a really unique book and a really interesting read as well. He's got a great writing style that's not too thick. So for a simpleton like myself, it was a very easy and digestible read. And I'd recommend that to everyone too, if you guys haven't read that.
Ping me the link to that, will you? Because we will definitely be asked for a link for that. So I will share that with everyone, but I will purchase that. Definitely.
Yeah, I'll put it in the chat here.
Nice. So we go to some listeners' questions.
Yeah, let's do it.
Mike has asked us, he's asked you, what do you look for in other financial content creators? And are there any that inspire you?
Oh, yeah. This is a great question. I think these days, this has been true from the very beginning. What's always been interesting to me is just seeing other people's portfolios. So I'm really drawn into people making videos showing, their dividend income for the month or just portfolio updates. I would say that those are my favorite kinds of videos to watch. When it comes to, making stocks, like 3 discounted stocks to buy, or, these stocks are at 52-week lows, kind of the more stock list videos, I don't tend to watch those as much anymore, just because I'm pretty sure of the companies that I care about and the ones I don't. And I'd rather get those ideas, I think, on my own. But I'm really like watching portfolio updates. I think those are my favorite type of videos to watch. And as far as the creators who inspire me, or the ones that I look up to the most, I think is probably easier for me to answer. I always have been and will forever be one of PPC Ian's biggest fans.
Same here.
I just feel like over the years I've learned just so much from watching his videos, and he's someone who's just been very responsible for making me want to focus in on dividend investing. So Russ is I watch every single one of his videos, and he's probably one of my best friends in this space as well, which has been the crazy thing about having a channel. These people that you used to watch and look up to have now become your friends, which is awesome. So those are 2 of my guys. There's another gentleman who's actually retired living off dividends, Kevin Burgess, who I actually think would be a really good guest on this show. One of the nicest guys I've ever talked to. And he did something in finance for a big Fortune 500 company. But he's retired, living off of his passive income, both from stocks and real estate. And every time I watch him, I learn something new. And he's, like I said, he's just the nicest guy. And he's someone that I look up to a lot as well. Those are the big 3 that come to mind. And I think, going back to the other question, what do you look for in a creator? I guess it's, part of it too is who can I learn from? And those guys, every time I watch them, I learn something new every time. So, those are my guys for sure. I don't know if there's another part of that. Oh, there was too. As far as inspirations go as well, I also find a lot of inspiration outside of finance, just that I can use for my own stuff. I watch a lot of workout contents. I watch a lot of content about, watches. I'm big into collecting watches. That's another one of my hobbies.
Yeah.
And so I get a lot of inspiration for YouTube outside of just the finance space. And that's been cool too. It keeps it interesting, I think.
Yeah.
Just watching other things. Yeah.
I agree. Russ and Ian both have been on the show, and two great people, I have to say. And we will definitely reach out to Kevin. I have a note about all this. Richard has asked, what goes into your choice of having multiple brokers? Is there a limit you would set per broker for portfolio holdings?
Ooh,
I don't know. I don't know if you have
know.
multiple brokers, do you?
I only have two. My main account's over on Charles Schwab. And the reason that I use Schwab, my whole family uses Charles Schwab. I didn't mention this earlier, but so growing up, I had a custodian account. My dad's big into investing in stocks. And so that's what really first introduced me to all this stuff. I didn't care about it at all when I was a kid, as I'm sure you can imagine.
Yeah.
But the account that I have on Schwab today is still the account that I had when I was 13, 14, 15, whatever. So that's the reason I use that brokerage. And then for my Roth IRA, I actually use M1 Finance. And I don't need to do that. I think it makes sense just to keep it under one roof, but I wanted to go with M1. I just wanted to try it because it looked like a very hands-off platform to use. Everything can be automated. And for my Roth IRA, that's exactly what I wanted it to be. I wanted it to be completely out of sight, out of mind. I didn't want to have to lift a finger when it came to what to buy, when to buy, or, whatever. I didn't want to have to, I basically just wanted to forget about it. And so M1 Finance offered me the setup to do exactly that. And that's the only reason that I went with that brokerage. Otherwise, I don't think there's much of a reason to separate them unless a certain brokerage has, like I was describing with M1, has certain features that maybe differentiate it, or there's something specific about it that, makes you want to use it over something like a Schwab or a Fidelity or a Vanguard. Yeah.
That's interesting, because for me, it's a bit opposite, because listening to you, I think Charles Schwab is very trustworthy. Yeah, with its long history. If you look in Europe, we have all those low-cost brokers, which are not banks. Our banks are way too expensive. If you go at a bank, you easily pay 10 euros commission still. Yeah, and many of those. So then you come with the low-cost brokers, and they're pretty much not so well known. And sometimes you hear the financial authority saying something about that, giving them a warning or something like that. So the trust level is much lower. Then you have Interactive Brokers, which is an American company, mostly known since then. Never heard of it before, right? Before I started investing. That's where I have the most trust in. So that's where I have the most volume of money. But still, like from a risk perspective, and we had also in the past, after the great financial crisis, we had these Icelandic banks that went bust and people lost their savings accounts and such. So I do have a little bit of the spreading risk there that I wouldn't feel comfortable, because also they are loaning out shares and everything. So do you really own it? That's the question. And this is really hard. There is not so much transparency either on this. So if it would be a traditional bank here around the corner that I've seen since I grew up, and I can check the financial statements and they give me like a low fee commission, I would probably have more comfort having all the money there. But I don't have that with these low-cost brokers that are not having annual reports that you can easily check. You see then sometimes those kind of reports coming from the financial authority that they ask them to change things and such. So, this is a problem in Europe, I would say. The traditional banks are like, it's just pure theft, what they ask.
Expensive. So we have to offset the expense with more risk. So that's why we diversify.
That makes sense.
We're screwed in Europe with all this stuff, Ryne.
Well, if you guys ever feel like moving to Vegas, I do have a spare bedroom. So,
well, I hope by that time that I can fund and rent my own place. But yeah, Vegas, baby.
There you go.
Don't tempt me. I won't come home. Andreas has asked you a question, Ryan. He says he sees that you always concentrate on buying stocks which are beaten down at the moment. And he mentions a 52-week low. And sometimes doing that, you can get on buying a weakening company. Not buying the dip for, I'm about to say not the dip, but there's a reason for the price. So he's basically saying that they're dipping, but it's for a reason. It's probably because the company is buying. What did your stats say? Is he wrong in his assumption that you're buying weakening companies, or are they good companies and it is an actual dip?
I think that it depends on the situation. My personal goal is to never buy a weakening company. And so if you see a stock share price heading south, part of your due diligence as an investor is to understand why it's going down. And I think we actually have a really solid recent example of this with the real estate investment trusts. You know, it was either earlier this month or late December, I don't remember which one, where here in the States, they announced that they would be, you know, cutting interest rates then, but here in 2025, they anticipate that they'll do less interest rate cuts than they originally thought. Now, that news had a big impact on real estate investment trusts, which, you know, interest rate fluctuations are a big deal because they use a lot of debt to grow their business. And so that's going to impact them. But anyway, long story short, that sent the share price of pretty much the entire real estate sector heading south. So a lot of REITs got hit, Realty Income, Vici Properties, you name it. They went down in price. Now, from my point of view, that macroeconomic issue, while it will have some potentially have some implication for real estate investment trusts, I don't think it's going to be one of those things. Let's look at Realty Income and Vici Properties specifically. I don't think that news, even though it made the share price go down, I don't think it's going to be a big long-term issue for the company. It might impact them in the short term, and it might lower their spreads on deals and stuff like that. And if they have to refinance their debt, it's going to have an impact. But I don't think this is going to be the end of Realty Income because they announced one less interest rate cut in 2025. The same is true with Vici Properties. So you have to come to understand why the share price is going down. And if it does seem like it's because the business is weakening, like if you look at Walgreens, that's another example of the opposite end of this.
Yeah.
You know, all you have to, that stock took it's just been a dud. It's been terrible. And all you had to do was look at the financials of that company to know that, okay, this is why it's going down. Sales were declining. The margins were deteriorating like none other. The payout ratio was going up. There was just a lot of big red flags that really justified why the share price is going down. But going back to the REITs, if the only reason they're going down...
Take notes, Derek. Take notes.
Yeah.
Go on, Ryne. I just want to make sure he takes notes.
No, but with the real estate investment trust, if the only reason they're going down is because of some short-term news, then fine. Like I'm happy to buy these companies at a lower share price because of that. And really, when you get to the root of what causes these share price movements, it's that news, sure, but more than that, it's market participants' feelings about that news and how they'll impact the company. And a lot of times when it comes to this news, this short-term news, it's a big overreaction. And that's why you see the share prices going down. And so I'm happy to take advantage of that.
For me, those are the nicest ones. Yeah, like I will never forget that Amazon bought Whole Foods, and I think at that time you could get Walmart for 3 or 4%, as an example, because Amazon stepped into this industry, so everyone would be killed. That never happened. And what if you see that and you have that conviction that you know, like, come on, guys, everyone lost their sense, like as if Amazon could be a monopolist in the entire grocery chain, supermarket, store world, then that's insanity, right? So I was loading up a lot on Ahold Delhaize, the Dutch equivalent on that. They have also Food Lion in the United States, and I'm looking at my average share price of cost per share of 19 euro. It's now trading at 34, but that I was buying it for 16 or 15 or 14 euro. I mean, that was dumpster prices. I mean, what has a Dutch stock with some business in the US then? But okay, what do they have to do that Amazon taking over the whole industry? I mean, to your point, right? And the same is here, like with real estate investment trust, solid balance sheet. They have all these. Okay, they have Walgreens exposure, but still, come on. You know, if you look at the diversity and how much occupancy rate that is of the entire portfolio, and then you see where it's trading, you just know, like, okay, you know, this is a yield because we invest for income, right? We don't invest here for total return. So for 5+% yield, I mean, it's hard to ignore it, right? With this real estate investment trust. So the only question, I guess, is like, do you think that the interest rate will be 5, 6 to 10 years from now? Will this be lower or higher? That's kind of a question to some extent. because then it may start impacting the balance sheet or the debt repayments and everything. But I can't see that happening in the world where we are, with all these countries full of debt. I can't see that these rates are then sustainable. I mean, it will literally put some countries in bankruptcy.
Yeah, I mean, if there's one thing that I've learned from reading this Creature of Jekyll Island book, it's that the banks, these central banks, have such a big hold on the governments. Like, I mean,
yeah,
they have to keep the system alive, or else the banks won't. They need to keep them in a state of perpetual interest payments.
Yeah, exactly. So I'm with you.
They can just keep printing money too. It's backed by nothing, so there's nothing stopping them from printing more.
Exactly.
And then comes inflation, but that's a whole different conversation.
Yeah. Jan has asked the question about companies in the snack, sweets, and soft drinks. It's kind of like the unhealthy food sector. These are traditionally reliable dividend payers, and they are under pressure. Do you think this sentiment is temporary, or do you think it could signify deeper challenges? I suppose Pepsi falls into this kind of bracket.
That's a good question. Is the context surrounding like Robert F. Kennedy Jr. and coming in and
it could be that, but I think it's more, well, from what I've seen, there's more of the health focus, particularly particularly the younger generation.
Perhaps. I mean, it's hard for me to say. I do think a lot of these businesses have been around so long, and people know, Reese's aren't good for you, Snickers or what have you, but they also know that if you eat it every once in a while, it's not going to kill you. And so, I don't know. I'd be surprised if these businesses weren't around and bigger 20 years from now than they are today.
Yeah. What I'm missing a little bit, Ryne, is what will be their next secular growth trend? What will it be? Because otherwise it will have to float around inflation, maybe a bit inflation, globalization, entering new markets for Pepsi, Asia, whatever, the Unilevers in the UK. Globalization was, I think, from the early 2000s to 2016, 17, maybe 2020 was where a lot of the revenue growth came from. That is stalled at the moment with what's going on in Asia and everything. So I'm that's the only thing where I'm wondering, like, that's what they benefited from. I don't see AI being, for instance, a secular growth trend for operational efficiency, productivity maybe, but not leading to more sales or something like that. So, and that's the only question I have with this. Is there something there that also then could offset trends like health conscious consumers and such?
Yeah, that's a good point. And I think that there's historically, I remember this as a kid, there's always been like trendy things to eat and trendy things to drink. Like I remember when I was a kid, the popular drinks were like Monsters and Rockstars and stuff like that. And some of these companies, like I think Pepsi ended up buying Rockstar. And today what I'm seeing, and I'm pretty outside of investing, health and fitness is another one of my big hobbies. And so I stay pretty in tune with what's going on there. And, these companies, whether it's Coca-Cola or Pepsi or the Hershey company, they can buy up different energy drinks. A lot, actually, we saw this recently with Dr. Pepper, KDP, Keurig Dr. Pepper. They bought a big energy drink company called Ghost, which is actually based here in Las Vegas. But Ghost started as, and still is, a supplement company. So they make protein powders, they make pre-workouts, they make creatine, tons of other supplements, vitamins, whatever. But their canned energy drinks have become very, very popular. And so KDP just picked them up, just bought them. And I think you'll probably see a similar, and by the way, like there's so many different brands. There are a dime a dozen these days. And so I think you could see these big companies.
So consolidation, kind of a consolidation.
Yeah. I think you could see them make some acquisitions, and the brands may still be there. Like Celsius, for example, had a very hot streak recently. I don't know how the stock is doing right now. I haven't looked, but I know for a while it was it was kind of one of those hyped up ones. But who's to say if and when its reign ends? Ryne is actually another brand. But when its popularity fades, who's to say that won't be picked up by a Coca-Cola or a Pepsi as well?
And this is what L'Oreal is doing, because L'Oreal is effectively a serial acquirer, and they can take those really small cosmetics and they can give them straight away global scale. Yeah, and via their whole distribution network. And this is, of course, what the Pepsis and the Coca-Colas also have of this world. Like, you can take a small upcoming brand and you can almost scale it straight away all around the globe with some marketing behind it.
100%. And the same type of thinking can apply to like snacks as well. You know, there's so many like protein-based chips and protein bars, and this stuff has gotten so good that it can be kind of indistinguishable from like a Reese's or a cookie or you know, a bag of Doritos or something like that. And once again, there's these brands are kind of a dime a dozen at this point. And so you could see that some of these big companies picking some of those up, and you're even seeing some of them already put out branded products around these already popular and recognizable brands. Like, I think Snickers has a protein bar.
I think there are many of also. I think Danone is full, and protein is definitely at the moment a thing. I see also consumers wanting to pay a premium for that because it ticks the box for the health consciousness. And so I think it's to your point, probably like also see those trends as a potential, as an opportunity here.
And there's going to be things that come beyond that. You know, at the end of the day, people are always going to need to eat. They're always going to need to drink. And so I think they'll find a way to make themselves a part of that process.
And for the lives that we are living, things that are quickly available, like snacks, I think that there's no doubt that will stay. So it's maybe then more about less sugary, all these kinds of things, and maybe protein. But I can't see that suddenly snack and fast food ends. I think it fit. I mean, in our lifestyles, if I see also at work, and people are just cooking less also since COVID and everything, because you can save time. Yeah, and if you can then get good food into your body really quickly, I don't see that stopping anytime soon.
Yeah, absolutely.
Philippe was thinking about investing in tax advantage accounts. Would you recommend doing it? In most cases, you require to be a certain age before you can gather those funds tax-free. So if you want to take them out early, you can't. So what are your thoughts? What are your thoughts on those type of accounts?
Heck yeah. I why not? I mean, you know, unless something unfortunately drastic happens in your life, you're like with the Roth IRAs, you can't pull that money without penalties until you're about 60 years old. And, you know, assuming something bad doesn't happen to you, you will be that age at some point in your life. And when you reach that point in your life, you will want as much tax-free income as you can get your hands on. And so I'm a huge proponent of having those tax advantaged accounts. And there's contribution limits, like with the Roth IRA, you can only invest up to $7,000 per year. So I'm a huge advocate of maxing that out if you can, and then building your taxable account where there are no limits or there are no rules or, you know, withdraw ages or anything like that on top of the tax advantaged. But yeah, absolutely.
What do you think, EDJ?
So I'm doing it via my wife's account, but I just want to be able to live off the dividends like in a few years. So for me, waiting till 60. So I'm kind of playing it half, to your point, Ryne. It would be good to have something there, but most of my cash, definitely I prefer it now, and I just pay the tax bill for it because I want to use the income much quicker. And when I'm 60, I assume that let's say I'm 60 or 65, I assume that over the next 15, 20 years, that my core portfolio on which I pay tax has compounded already to such a level that it easily maybe doubles the income compared to expenses, just via proper compounding. So that's why I don't see strong incentive for this. Yeah, that is mainly the reason. But I still want to make use of it so that later, if something happens, at least I can tell, we did something with it.
Yeah. That's a good point. It does depend on your time horizon as well. And I'm in the same boat where I'm 31, but I do plan to start using some of my dividends sometime, hopefully at this rate, if it keeps growing at this rate, when I'm in my mid 40s,
Yeah.
which is long before I can withdraw from my Roth IRA. But still, and this just goes back to having balance, which it's kind of the theme of my whole investing process. Balancing out the flexibility of the brokerage account, the taxable account, with the benefits of the tax advantaged.
Yeah, true.
Lucky we don't have this problem in Ireland because we don't have a Roth IRA or an ISA. We just have pensions or taxable accounts. So
are the taxes pretty
yes.
Are they? Oh, really?
Yeah. Let's not get started on taxes in Ireland because I'll go off on a rant. It's
okay.
It's only beneficial for companies like Apple, but not for citizens.
If you're a company and you want to evade tax, come to Ireland. But if you're an individual
and you want to pay tax, come to Ireland.
Rafa has asked you about a ticker called ODFL. He's watched your YouTube video on it, but he wants to know your business bull thesis on this one.
So ODFL is Old Dominion Freight Line. It is, I think, definitely the country's largest, maybe the world's largest LTL distributor or shipper, and that stands for less than truckload. Basically, this means that in shipping products around the country, they will ship multiple products from multiple customers at one point in time, as opposed to like a full truckload just for one customer. Now, like I said, they're the biggest to do it. They have the highest satisfaction rate amongst their customers. Basically, no one complains about their service or product, or their service. No one has anything bad to say about Old Dominion. They really go out of their way to do the right thing by their customers and ship things at a timely manner, which they have a high success rate of doing. So I think, generally speaking, it seems to be a really ethical company, and they try to do the right thing, which I appreciate. Now, in addition to this, because they are LTL, they have all of these distribution centers around the country. I think at this point they have maybe about, they have about 260 distribution centers, 90% of which they own. So they have a really strong, in addition to their, core service, they have a really strong real estate portfolio of all these distribution centers. And they have that process dialed in, which I think serves as a competitive advantage for them. Very efficient shipping, which is why they're able, in a very efficient process, which is why they're able to have such high satisfaction from their customers. And I think that can be a hard thing to replicate. So all of that sounds good. And all of that trickles into the financials. If you look at the just financial profile of this company, from top to bottom, it is a growth monster. The revenue growth has been insane. The earnings per share growth has been the same. And the free cash flow growth is just like the first two. Everything is just up and to the right, double-digit growth rates on average too. And I do believe, I could have this wrong, but I don't think the company even has any debt on their balance sheet. If they do, it's amenable. And if they do, they have more cash. I could have this slightly wrong. Let me actually look this up because I don't want to be wrong. But they don't have, maybe I can't do it super quick. Bear with me because I want to get this right. They either have no debts or they have very little debt, and it's easily covered by their free cash flow. Okay, so I'm going to give you some numbers here. So negative net debt. So as of their last report, they have negative $14.2 million of net debt, which means they have $14 million more cash than they do total debt. So, I don't think this company is at risk of going bankrupt anytime soon. And so, financially, it's a very strong company. Looking at the dividend stats, one of the not so great things is the starting yield is less than 1%, but the dividend growth CAGR over the last 5 years is just insane. I think it's 35%.
Wow.
Which is that I can't think of a company with a higher growth CAGR off the top of my head. So it's just ridiculous. So, I think there's a lot to like about it. On the other side of that, the one thing to consider is that, the trucking industry is a very fragmented industry. So they do have a lot of competitors. And if you think about it, it makes sense. Like, how difficult is it for someone to decide if someone wants to start a trucking company, all they need to do is just buy a truck and they can do it from there. And so I would say that is one of the biggest risks, is just how fragmented the company is. But or the industry is. But otherwise, I think it has a lot going for it.
Yeah, it's just a bit pricey for my liking. 33 PE at the moment.
Yeah,
Tough to buy in, but everything you said sounds great. I'm looking at it here, and no debt. I mean, 35% 5-year CAGR is crazy. I mean, how does that happen? So
that's one of them that's on my quote unquote very interested list. But to your point, Derek, it's just not the right price. It's getting better. Like it's come down in price some, but I'd still like to see it get a bit cheaper.
Yeah. Okay, and then the last question is from Marcus, and he mentioned he loves your channel, but it'd be interesting to know, what are your favorite European dividend stocks, or do you know any?
Oh yeah, I've got two great ones for you guys. These are both on my watch list. One of them is LVMH. Just, the financial profile of that company is actually very similar to what we were talking about with Old Dominion. Just such a great company. That one, and then actually L'Oreal is on my watch list as well. I'm really interested in, I was going to say I'm really interested in the beauty industry. No, I mean, not really, but I do think it's interesting. It's interesting to see how people, how they are with these products. It seems to be quite sticky. I mean, we kind of think of them as consumer discretionary products, but I think it's more of a staple. Times good and bad, people want to look good. Women will still need foundation and skincare. I mean, same here with me, but with skincare. But it's just one of those things that no matter what's going on, kind of like groceries, people will continue to buy. And not only that, L'Oreal also works with some of the, biggest luxury companies in the world in fragrances too, which I think is something a lot of people forget about them. So, and also just professionally, I think they have Redken, Pureology. They've got a lot of professional beauty products, which are like the biggest ones in the world. Redken, like there are Redken schools here in the United States that are kind of the cream of the crop. You aspire, if you want to go and be a hairdresser, you aspire to go to one of the Redken schools. So those two I would say are top of my list for European companies, but I'm a bit hesitant because I don't fully understand. They're both French companies, and I just don't fully understand the relationship of businesses with the government there. So I think that's one thing that keeps me on the sideline, but otherwise that lack of understanding is the only reason I don't have both of those in my portfolio.
We have seen it during COVID that the French government was effectively forbidding companies to pay out a dividend. So,
oh, really?
Yeah, it did happen. Where they had control, there was no dividend, like banks and everything. But LVMH did a small dividend cut at the time. L'Oreal, I think, kept it flat. They really tried it. There was really put a lot of shame on companies that were paying dividends at the time. Most of the European companies, because they don't pay quarterly, they pay like annually or biannually. They postponed their annual general meeting and therefore also the dividend decision. But the ones that were early, they were kind of in trouble, and we saw a lot of dividend cuts there. So there's definitely more influence and sensitivity there to than compared to American companies. But I do think LVMH and L'Oreal, they have this pressure the least from the French companies. So I think, but that's why you see that European companies are having lower multiples generally. Yeah, that's the reason for it. But LVMH, for me, this company is so impressive. Like it's Louis Vuitton, right? So you think about the bags, then you think about Moet Hennessy, you think about the champagne, but then they own here like a Polish vodka, Belvedere. And to my surprise, they own the suitcases, Rimowa, I think it is. Like, I mean, go to an airport, and you want to see the business class people. That's kind of suitcases that they have. But then they buy it, and when I bought mine was before LVMH bought it, and I bought it probably for €300, $300, and now they're like $1,000. Yeah, so they spot really well the brand. They see where the pricing power is, and this is what always like Buffett and Charlie Munger says. Like, if you see a product where you can hike the prices still much more, you have like untapped potential. And LVMH is founder-led still. So this guy's just brilliant. And he sees this stuff. And so they mostly grow via, besides global expansion, that's why it's stalling now with Asia. they grow via acquisition mostly, and they're really good at this because they buy relatively small companies and give them a global scale, and that's what they're really good at that.
And they also have, I don't know a lot of the specifics around it, but they do a lot in real estate as well. And also retail. I mean, in addition to their own stores, they also own Sephora. So going back to the beauty industry.
Exactly. I mean, these are holding companies, like to your point, Staples. That's what they are. And they really know, and they are in a business where there's premium pricing, and people tend to be less price sensitive. And actually, there's probably this price elasticity, I don't know the English word, but that if they hike prices, it might be even become more interesting for consumers to buy it.
Mm-hmm. Yeah, and they can control the scarcity of those products too, which plays into that.
Exactly. Yeah. You have Hermes, Hermes International as well. You should Google that one. Typical, also French dividend aristocrats. That's really insane. If you go to their website, what you pay there for stuff. But yeah, nice ones.
Cool. Yeah. Okay, we might finish up then with your favorite stock of the week. What are you looking at? What are you looking to buy?
Goodness. Vici Properties.
Yeah.
I think that's what I picked up a few shares with some dividends that came in this week. That's where I put it into Vici. And that's what I've been buying these last few weeks. I pretty quickly went from like the low mid 30 per share to like $28 per share. And so that was something I definitely have been wanting to take advantage of. And so, yeah, I've been scooping up as much Vici as I can get my hands on.
Las Vegas is still high then. It's still going good.
So yeah, let me tell you, with boots on the ground here in Vegas, and my wife works on the Strip. I mentioned, I don't know if we were recording yet, but she works at Planet Hollywood, which is like center Strip. So it's right next to, like Caesar's Palace and Bellagio and some of those. Every time that I'm down, every time she comes home, I ask her, was the Strip busy? Was it busy down there? Were people walking around? And it's always, discretionary spending, travel, drinking, food. It's all alive and well here in Vegas. It's just, it's thriving.
Yeah. I can verify that. I was there in August, I mentioned, and the amount of times I heard when in Vegas, when people just spending large amount of obscene money on just rubbish. It's like, when in Vegas. So I'm like, okay, I can roll with that.
I'm very interested in this because I want a REIT in my portfolio, and I've been looking a bit at Vici, and I have this issue with not with gambling itself, but that I don't understand why people gamble. So what can you explain me maybe? And I've been a few times in America, but I've never asked Americans in a casino why they are throwing money in it. So what is it in the American culture that attracts people to Vegas, firstly, and then secondly, like, that they just pour money in these slot machines knowing that you lose? What is it? Because it's hard to grasp for me as a European where we don't have this culture.
It's really the same. It's just something rooted in human nature. It's not an American thing. It's the same reason that people like to buy risky speculative stocks.
Mm-hmm.
It is just the allure of quick win, or play the lottery even. It's the same thing. It's the allure of winning a lot of money in not a lot of time. And that, when you get to the root of it, that's why gambling is so enticing to so many people. And also that's why people get hooked on it, because they always think that they're one roll of the dice away from winning back their money or making it big. And so it's easy to get people hooked on that. But I think that's what it is, with gambling. But the thing about Las Vegas, it's really, and they've been conscious about this. They have tried to expand it beyond just people coming for gambling. They really want to make it a dining destination and overall experience. Dining, drinking. There's so many cool bars and stuff. Entertainment as well, not just in terms of like shows and stuff, but sports too. And so they're really trying to make it a holistically like fun experience, and have a lot to offer for different types of people. But when you get going back to gambling, I just think that's what it is. It's the same reason people buy stocks that they know that they shouldn't.
Yeah, I agree with you. And I was there in 2015, was the second time, and I feel there was a lot more people gambling back there than last year when I went. There was the same amount of people. It was still as busy, but all the bars, all the shops, all the restaurants were full, and I didn't see as many people gambling as I did maybe 10 years ago. So I agree with you. I think Vegas is more than just a gambling destination. I think it's you want to go out, party, have fun, go to Las Vegas.
So maybe
I think part of that too, that maybe there's not as many people gambling is because it is getting more expensive. Like they've raised a lot of the table minimums, and it's easy to kind of blow your wad in an hour. And then if you're in Vegas for like 2 or 3 days and you lose all your money on day one, it just kind of leaves a bad taste in your mouth for gambling the other days.
Yeah, and you mentioned Planet Hollywood. We're a bit cheeky. They've decreased the odds in when you get a blackjack. So you have to go off the strip to get the good odds, but on the strip they've decreased it. And for casual people who wouldn't be into gambling, they would not probably notice. I like blackjack. I play it a bit. So as soon as I saw it, I was like, I'm not playing a blackjack in Planet Hollywood. I went down to Ohio down the road, and it was proper odds. So
yeah, you have to kind of go down to Fremont Street, which is the quote unquote old strip, and
it's crazy.
Yeah, it's definitely definitely a bit more dicey down there, but you get lower table minimums. I think you have less just with roulette. I think that because on the strip you get like single zero, double zero, now triple zero.
Triple zero, yeah.
I think there's some that have triple zeros. I just don't think you see that as much down on Fremont Street. So I think that's where at least a lot of the local gamblers will go down to Fremont.
Yeah.
But we have our European version with Evolution.
Yeah, so, that's a great looking company.
Yeah. So it's being hammered down lately as well because of the UK regulators and such. But Evolution, with all the approvals also for online gambling coming state by state in America, that could be really a potential catalyst there.
Mm-hmm.
Yeah, good. Hey, thank you for clarifying, because for me it's a bit alien. But what stuck with me is really this experience hub, and we can see with the Formula One. Yeah, that came. So, I mean, the eyeballs in Europe now on this due to Formula One is of course also increased. Yeah,
but I'm with you. I'm not a gambler myself at all. Every once in a blue moon, I might throw $20 down on roulette or play blackjack. But as soon as that's gone, that's good enough for me.
Yeah.
So beyond that, I think it can be dangerous. So I don't even mess with it. I understand how people can get hooked on it, but knowing how easy it is, I don't even know why. Yeah. Anyway.
But anyway, we can earn money from it, right? And it pays dividends. So that's what we are in. So
yeah, absolutely. Better off putting money into dividend stocks at the end of the day.
Yeah,
exactly. Long Vici. Anyway, thanks a million, Ryne, for coming on the show. It's been a pleasure. It's been great to chat with you. I was looking forward to this all week. So thank you for taking time out of your day and sharing with us.
Well, thank you, fellas. Likewise, this was a very full circle moment for me. Really cool experience to be able to do this with you guys. And anytime you need a guest, would love to come back on and chat with you guys, because this was awesome. You guys are the best.
So people can find you on YouTube. Yeah. So we'll put the link in the description. I believe you also have a website.
Yeah. My website's just Retire with Ryne. Retirewithryne.com. You can just Google that as well. Probably easier. But every single week, I also put out an email newsletter where I just show what my buys are for the week, my dividend income. I usually have some sort of main topic pertaining to investing that I'll write about, whether it's like, which stock I think is looking good for the month, or, I write about a lot of the things that I learned from reading as well. The things that I'm reading, I turn into book notes, which I also turn into newsletters. So it gets a bit more in depth beyond just my weekly buys and dividend income. So yeah.
And then on social media, what are your main accounts where they can reach out? Instagram?
Yeah, truth be told, I'm really not that active on outside of YouTube and my newsletter, but I do have Twitter, and my handle is just Retire with Ryne. You can find me on Instagram as well with the same handle. I'll post my runs and stuff on Instagram. So if you're interested in that, follow me on Instagram. But Twitter, I don't spend any time on there at all these days.
Good. So YouTube, website, newsletter. Awesome. We'll put the links in the descriptions.
Awesome. Well, thank you guys once again.
Okay. And all our listeners, we will see you all next week.